Hello and welcome to the Money Show, where we take the mystery out of managing your money one step at a time. I'm Kavita Thapliyal. Whether you are just starting to think about your finances or you're a seasoned investor looking for the latest strategies, the Money Show is your go-to guide for making smarter, better financial decisions. From the stock market buzz to personal saving tips, from retirement plans to tax hacks, we are here to decode the world of personal finance in a way that's simple, clear, and most importantly, actionable. And today we've got an exciting lineup of guests, of experts, insight, practical tips, and your burning financial questions answered live. So all you have to do is just stick to your TV sets, because when it comes to managing your money, every tip counts. And this show is also about getting your financial portfolio queries answered, or your portfolio checked. Is it aligned with your financial goals or not? So all you have to do is just send across your queries on our WhatsApp number. The number is flashing on your screen. It's 865-797-4571. There's also an email ID where you can send across your question, which is themoneyshow@etnow.tv. So anything where you want our expert advice, whether it is about lining up a financial goal or checking the right kind of strategy that's needed for a particular goal, we have you covered. And not only investments, even insurance, how to get the right kind of credit card for you, or how to get done with the amount that's as a liability on your credit card. We have you covered on every aspect of your financial journey. All right, so that's what the Money Show is all about. But let's begin. And today the topic is very exciting. So in recent year, there's been a surge of excitement around getting in early, especially when it comes to investing in companies before they go public. Yeah, we're talking about pre-IPO. So pre-IPO investing has become the buzzword, whether it's startups turning unicorns or established names preparing to list. Everyone wants a slice of the action before it hits the market. But here's the catch. Being early doesn't mean being profitable. To take a few names, from the Paytm to Cartwright stories to LIC IPO, we've seen how unlisted hype can turn into listed heartbreaks. We'll also flash few graphics on the screen which will talk about the journey. Now, unlisted investing can unlock serious potentials, from entering at relatively lower valuations to riding the wave of a strong listing. But this is not a playground for the uninformed. And the reason why we are saying this is there's less liquidity, there's limited disclosures, and no uniform pricing, meaning you could be overpaying without even realizing it. So today, we cut through the noise. We'll talk about what really matters in the unlisted space: valuation, timing, due diligence, and most importantly, your exit strategy. So if you're considering taking the plunge into unlisted shares, or you're just curious about how this market works, you've got to stay with us, because this segment might just save you from a very costly mistake. I have with me Atul Shingal, founder and CEO, Scriptbox; Lavai Navlakhi, MD, CEO, International Money Matters. Hi, and good evening and welcome to the show. Lavai, let me just come to you first. And, let's talk about the valuation and the pricing ambiguity that's around this particular space. Many unlisted shares today are, already priced aggressively. Now, having said that, how can investors gauge fair value in the absence of standardized pricing or regular financial reporting?
Hi, Kavita. Thank you for having me. I think for any investor and any investment decision you make, it's all about whether the price is worth it or not. It's not the time when you get in, but the price at which you get in, particularly when it comes to unlisted. I think the information, obviously there's a gap. You don't have published, audited, regulated information available. So people possibly get swayed by rumors. It's good if you can go through the MCA website and look at company financials, so that you can at least gauge whether the industry they are in, the potential that it has, the business that it's doing, the expenses it has, the profitability that is potentially there, is all worth the price at which those shares are being bought, traded, and invested in.
So, Lavai, there's unlike listed stocks, I just want to understand there is no PE ratio or volume data publicly available. Okay, so what valuation frameworks or reference points do you recommend when looking at unlisted shares department?
See, I mean, if you go through basics, you will look at if there is data of more than 1 year, then go back to history and see whether profits are growing, at what rate they are growing. And if you can see a consistency in the growth rate, then maybe that's one of the benchmarks that you keep in mind. If there are any other listed shares in that space already, then that is a comparative. Then you can look at what that company is listed at, and therefore what is the likely price that you will get for this unlisted stock. If there is none, then it may be best to look at any equivalent industry. And it's difficult, obviously, to do this. And I think for retail investors, this is something that you would really tread with caution because of this lack of information and the opaqueness that exists. It is best that you determine what quantum of money you're keeping aside for it. And while you may think this is going to be a lottery and the bumper lottery that you'll make, there is also a chance that you will be stuck with that investment for long because the company may not list it, may delay listing. And of course, the price at which it lists may be substantially lower than the price at which you bought.
Very interesting point, and I'm just going to take it ahead from here. And Atul Singhal has also joined us from Stripbox. Atul, hi, good evening, and welcome to the show. So now, taking Lavey's point ahead, I really want you to help our viewers understand how do you differentiate between early entry and overpaying early. Is there a threshold or red flag you watch for in pre-IPO valuations, considering the timing?
Thanks, Kavita, for having me on the show. And obviously, the industry expert, Loai, is here, so there's very little I can add. But I think I'd just take a step back, Kavita. I think unlisted shares as a category, let's think about startup investing in a bigger category because there's a lot of hype around investing in startups from the very beginning. So I'd like to sort of start with saying that, first of all, investing in startups is high risk. Yes, high return possibly. The statistics say that 90% of startups which are funded there's a 90% mortality rate. So be very careful. There's a 10 to 12 year liquidity period if you're starting very early, and you need a large amount of money. The second rule is that you should not ever allocate. And why are you buying startups, or why are you investing in IPOs? Is it part of your asset allocation? Are you speculating? Do you want extraordinary returns? Or depending on what your drivers are, you will do the right kind of stuff. Now, coming to IPO, pre-IPO, as you're calling it, while how to determine price is unknown, the most scary thing about this category is unregulated, right? There is no regulation which actually regulates the pricing, the transactions, the participants in this particular category. We've obviously seen fraud in the recent cases because it's, after all, somebody's word against somebody else. So while keeping this mind and sort of determining how valuations come to it, I think for retail investors especially, and even for HNIs, and I'm taking up to 10, 20 crores of net worth, this is probably a category you want to stay away from because there are better investments. And as your data is suggesting, if I look at the IPOs from a last 3 to 5 year perspective, at least 50% have not even crossed their issue price, and probably 60% have not beaten the Nifty. So keeping all of this in mind, how to determine valuation is very, very hard. Our advice is get the disclosure in place, read the DRHP. That's a much better time to enter this category. Now, if you have to do it, make sure it's not more than 5% of your total net worth. Be aware that this could be high risk. Liquidity, like Loai said, could be very low. Some companies who have been trading for 3 years in the gray market. And remember, it's called gray market for a particular reason. Have
Right.
still not listed. So you're stuck with an illiquid stock. You don't know her price. There's no research available. Like Loai said, you have to go to the MCA site yourself. Just this combination of lack of research,
Right.
lack of regulation, lack of liquidity, lack of price transparency, unknown
Right.
players, I would just say be careful. Sorry, I'm being contrary and I'm
Exactly.
not
So,
telling you how to make it work. I'm just telling you why you should be afraid.
No, I mean, these are the, checkbox that you should be keeping in mind and the red flags that one should be considering before putting in their hard-earned money, Atul. But having said that, I really want to focus slightly more on the liquidity and the exit factors. Now, can investors realistically expect a listing premium today, or is it that the optimism is misplaced in the current IPO environment, or because of that, it's all misplaced? What is the reality, Atul?
Again, I go back to why are you investing? We being wealth advisor,
Okay.
wealth managers, helping people invest their money for the long term. My suggestion is if you're not thinking about the company for the next 5 to 7 years, and if it's an equity transaction, you shouldn't be doing it. So what does the category look like? And your determination of value or your determination of price is we got to be sort of tempered with your time horizon and the risk you're ready to take at this point in time. Now, other valuations run up, and there are many cases where, as we've seen in some cases like NSE, which has been trading, or as we saw in the case of HDB, it goes down. So, keeping this in mind, I do not have a specific answer as to how to determine valuation or is there a hype around it. But I think, given the slew of IPOs that are being planned in the next sort of 18, 24, 36 months, rationality will prevail, better pricing mechanisms will come in, and ultra HNIs who possibly can participate through this. And as I think more recognized participants with better credentials start doing better research and better pricing for this, we'll get a better view of this for in terms of what is the right time to exit. If you have bought it for pure speculation, right? You said, okay, I have insider information. It's like somebody on the highway saying, there's a highway coming in my neighborhood, I'll buy land. Now, when that highway is going to get built and has the price already run up, you don't know. So similarly, I don't know what the right valuation is, but yeah, if you come in for speculation, you might as well buy a lottery ticket. And yeah, if you
Absolutely.
get lucky, if you get lucky, you get the
Absolutely.
money.
So, Lavay, let's also focus on, the due diligence and access to information part. Now, investors often rely on intermediaries or platforms, to access unlisted shares. I really want you to help our viewers understand how reliable is the information being shared and what kind of diligence should investors do independently.
What we have seen, frankly, in the marketplace is that sometimes there are people who have got a very large block of shares available, and that is what they are trying to offload. So you will see what Atul mentioned, like an NSE. For years now, it's been doing the rounds and saying, okay, they are about to list. And for many people, that price at which it's going to list is totally speculative. And people feel that if they do not get in, they will miss an opportunity. What we have also seen in those where people are actually interested in investing in that stock, if you actually go back and negotiate with the party who's selling the stock, you're able to get a discounted price. And depending on who is more desperate, the deal sort of swing. So that itself tells you very much it's like buying property where my perception is that this property is worth X rupees a square foot. The seller's perception is it's X plus something. And then you're trying to negotiate and find a via media and a price to buy it. There is no
Right.
regulated mechanism to determine that price. And therefore, it is
Exactly.
fairly dangerous.
Right, right. All right. So, Atul, now since we are focusing a lot on doing your homework right, I just want to ask that given that these companies are not obligated to publish quarterly reports, or investor updates, now how can retail investors ensure transparency and track performance over time? Would you advise retail investors to, request MCA filings or audited financials before participating in any unlisted offerings like that?
So I don't want to sound like a sales guy or plug a product. There is a company called Pro 42. There's a
Okay.
company called Pro 42. I have a vested interest. I'm a founder of that company too. You can have a look at that. That's a platform which tracks financials of all unlisted companies. And it's got a track record of 10 to 12 years. You can have a look at that. There are other similar platforms which give you information on private companies. Obviously, there's a subscription, you have to pay money for it. But if you are really serious, I would suggest finding a platform like that because MCA is very difficult to interpret. So finding a platform which gives you information on the company, gives you 3 to 5 year track record. Maybe if you can ask your intermediary who's actually selling you the stock to give you deep information, give you a report on the company which tells you what the track record is. have some pre-reading available, look at the category itself. What do you expect the total addressable market of that particular industry? Is the player who's coming in, do they have a first mover advantage? So classical research evaluation thing, is it new technology? Do they have a large enough market? Do they have a track record? Is their brand recognized? What do you know about the management and their track record? What are the news article about? How have they performed? Is there any fraud in the company? So do as much due diligence as you can on the information available to you. Ask the hard questions because it is your hard-earned money. And if you want to take a position on a particular company, make sure you're not. Don't buy the most glittery sort of toy in town, right? It's unfortunately, as that ad said, "Dil mange more." A lot of investors are always looking for the new next best thing, the new thing. So just don't buy the story, buy the content, buy the deep research, do a lot of diligence yourself, and then take the plunge. Because it's very important that you do this.
Sure.
Again, find a partner who can help you with this research.
All right, or all they can do is just watch the Money Show as well and watch you both as experts giving the right kind of advice for them. Thank you so much, both of you, for being of help to our viewers today and taking time out for this. Thank you so much.